Do you need help protecting your finances as you enter retirement? David Dickens of KC Financial Advisors has got you covered. Welcome to the Cover Your Assets KC podcast.
It's another edition of Cover Your Assets KC. Walter here alongside David Dickens, President and Wealth Advisor at KC Financial Advisors. And today we're going to be talking about irreversible financial decisions, how you can get these things right the first time around because, well, bad news, there is no second or third chance at getting these things right. Can't wait to talk about all of that with David. But first, let's check in post-Labor Day. Looking forward to kind of the start of football season. NFL's around the corner. David, I hope you are well. What else is going on in your world this time of year?
Oh, well, let's see. I'm actually, later today, I'm driving down to Texas. I'm going to be playing in when this podcast drops, I will be on the golf course with my brother. We're playing in a tournament. And so I'm really looking forward to that. It'll be a lot of fun.
That will be awesome. Do you and your brother get to play often, or is this sort of a special occasion?
Well, we used to play some when we were kids growing up, but we've always lived in different towns. And so we really haven't played all that much golf together. When we do, it's usually with a couple of his sons. And so it's always a fun outing. But this is just going to be him and me against a bunch of his tough-minded club members, and so hopefully it'll be a lot of fun. It's always a lot more fun if you play well, I know that.
That's right. Yeah, I'm sure if you do well, we'll hear all about it on the next show, and if not, we'll just gloss right over it.
Exactly.
Fantastic. Well, let's dive into today's conversation, try to help some folks out, David. Plenty of decisions that come up in the retirement planning process. Unfortunately, they can't be undone. They're kind of one-time deals, and so we're going to make sure that you are making the right call on these different items. On today's episode, we'll talk about why these are such important decisions, why they can't be undone, and how you can get it right the first time around. We've got 4 specific ones, at least, to give you on the program today. Let's start in the Social Security realm, David, and that question of when to start Social Security. Not only is it important, but we can't really put the toothpaste back in the tube once we make that choice.
Yeah, you're right. So pre-2000, I think it was about 2010, you used to be able to put the toothpaste back in the tube. But after that, the Social Security Administration said, nah, once you make these decisions, they're pretty well tight. So right now, under current law, once you get past the first 12 months of claiming benefits, you can't redo. But within the first 12 months, you actually still can make a redo. You got to pay back all the taxes, you got to pay back all the money you got. If you were on Medicare premiums usually come out of your Social Security, so that you got to pay those back. And if there was any money that was paid to your spouse because you started at the same time, and if he or she were on you're drawing based on your retirement, you have to pay that back too. So it can get fairly twisty, but there's a form that they have. It's called a 521 form, and you can do that. The question might be, why would you do that? Are there any good reasons why you would want to get a redo in that first year? Well, I can think of a couple. Let's say that at the time you took it, you were unemployed. Maybe you were unexpectedly unemployed, and you said, you know what? I don't think work's ever going to come back, so we better start. You start getting Social Security, and then boom, you get a job that you feel like you can hold for 2, 3, 4 years or however long you want, and you decide, I'm going to stop. I want to pay all that back and get a redo. So that doesn't happen very often, but that's a perfectly fine reason why somebody might want to do that. Another might be you started early, and then you realized, the spousal benefit that my spouse will receive if I die first is going to be reduced because I started early. And we didn't really need the money, and so I wish I could redo that. And you can in that first 12 months. So those are a couple of reasons. There are probably 3 or 4 more good ones. But the vast majority of people, once you start, you're going to keep plowing ahead. There is once you reach your full retirement age, in my case, that would be, all of our listeners, it's somewhere between 66 and 67 years old, depending on your year of birth. Once you reach your full retirement age, if you've started, you can suspend for a month, 6 months, year, 2 years, whatever, up until age 70. If you say, oh gosh, I wish I'd waited. there's no payback. You don't redo. You just suspend getting those payments. And then when you restart, the payment is bigger because of the payments that you had missed. So that's kind of the story on Social Security. There's a few different ways to do it, but as you're making your plan, you should really consider that once you start, that's a decision you're going to stick with.
I really like that, David, and definitely makes a lot of sense when we're talking about that Social Security piece of the puzzle. One of those things you want to get right from the start. What about this next one? How rigid is the decision when it comes to electing spousal benefits on your pension, or I suppose the flip side of that, not electing those spousal benefits?
Right. This one, I've never known of anybody with an ability to do this. This is totally irreversible as far as I have ever known or ever read about. So it's a super important decision. I've got a couple of numbers here to think about as to what makes it super important. So this is loosely based on a client of mine who retired 5 or 6 years ago. This person was offered, well, I've called out 4 different alternatives that they had for their pension. One was just on his lifetime, $5,420 a month. That's about $65,000 a year. But if he chose the option of, well, I want it over my lifetime, not including my spouse, but I want to make sure that we get paid for a minimum of 10 years. So lifetime with a 10-year guarantee, having nothing to do with his spouse, other than if he died in year 4, she would get the money for the next 6 years. Instead of $65,000 a year, that was about $59,000 a year. So $6,000 less, 10% less. There was another option where they would pay him for as long as he lived, and then whenever he died, she would continue, as long as she was still living, she would get 50% of what they had been receiving. And in that case, while he was living, instead of $65,000 for just his life, they'd get about $56,000. And then once he died, she would get about $28,000 for as long as she lived. And then, of course, they could have taken a lump sum, and that's a whole nother podcast, frankly. We probably did one 2 years ago on whether to take a lump sum. But when you're making this decision for your pension, whether you're including your spouse or not, or one of those decisions in between, once you make that decision and you start receiving the money, you are not getting a do-over on that. So just make sure you get it done the way you want, and hopefully it fits really well into your plan.
Get those decisions right the first time. That's why we're talking about them on today's show, these irreversible financial decisions. Now, our third one, David, sounds like you could reverse it if you just stopped paying for it. That would be getting life insurance. What's irreversible about that?
Well, you're exactly right. You can discontinue your policy anytime you want just by stopping to pay the premium. Kind of the irreversible piece of that is at some point you might become uninsurable. So, the life insurance company's job, the underwriter, is to make sure that they're not writing a $500,000 or $1 million death benefit, and then you pay on it for a year or two, and then you die. That's been a really bad decision for the life insurance company. So that's why they underwrite these things, to check on your health and your longevity and that kind of stuff. So if you are super healthy, then you're going to get underwritten fairly quickly, and you're going to get a pretty attractive price for that life insurance policy. But if you've just recently had a heart attack or two, they may not be willing to write it at any cost, at any price to you. If you've had maybe some colon cancer or some other type of cancer, well, they're going to want to see that you're 2 years away from being cancer-free before they'll even write a policy to you at any price. So what you don't want to do, if you're convinced that you are going to need life insurance, easiest to get it when you're insurable. If you're insurable 2 or 3 years or 5 years from now, you can always cancel the first one and get another one if it's at a lower price, a better terms, whatever it is. But once you're uninsurable, it becomes a problem for you and your potentially your family and your estate. I will mention one strategy. It's kind of a one-off, Walter, but I think it would be interesting for our listeners. We had a client probably 5 or 7 years ago where they were interested in leaving some tax-free benefit to their heirs, to their kids in this case. And he has Parkinson's, and she's totally healthy. And so you would normally think, well, with Parkinson's, that's going to be a problem. But what we did was get a second to die policy for this couple. And so the underwriters are looking at it going, well, he's got Parkinson's and that can be problematic, but she's totally healthy. And all we care about as the underwriters are when is the second of them going to die. So these folks got a remarkably good price, monthly basis for, monthly cost for this insurance for a fairly significant death benefit, because the underwriters realized, all right, we aren't just insuring one life here. We, as the underwriters, get the benefit of 2 lives, and one of these people looks really healthy to us. So there's several ways to skin a cat. Sometimes it has to do with the problem you're trying to fix. Sometimes it has to do with the quality of advice you're getting. But if you've got a problem you're trying to fix with insurance, make sure you ask enough questions to make sure that there truly isn't a way to fix it, because a lot of times there is.
That's really helpful, and I think that's interesting to note those nuances of the life insurance conversation and those irreversible parts. Great breakdown, David. Let's get to our last one here. Point number 4 is choosing a retirement date. I do suppose this one could have a little bit of an argument that it's not fully irreversible. What do you think about the choosing a retirement date and including that in this category?
Well, it's certainly reversible, but I think the risk is that you very likely wouldn't be able to re-enter the same career at the same level that you had once you've been out of it for a year or 2 or 3 or 4. You may be able to go back to work. Let's say you may need to go back to work because of money. You may need to go back to work because you're going stir crazy and you just want something to do. That's a lot easier to fix than if you retired too early. Maybe you had an accident in your investment portfolio. Maybe you had a miscalculation. Maybe you didn't have a real plan and you realized, oh my gosh, I got to have a couple $100,000 more to get us to where we're going over the next 25 years. So if that's your case, it's not irreversible, but you've made a pretty bad decision that you're going to wish you could reverse. All of it very situational. But I think that's all 4 of these topics, but this one in particular begs the question, how good was your plan when you decided to actually retire? And so, I probably find a way to work this into every podcast we've ever done, Walter. But the plan, having a plan, is where it all starts in my business. You can make a few investment mistakes along the way. You don't have to be really right. You just don't want to be really wrong. Not having a plan is probably one of the worst decisions that you can make when planning for your retirement, is just thinking, I'm pretty sure it's going to go well. That's usually bad for a nice long vacation, and it's definitely bad for a 25 or 30-year retirement. So make sure you've got a plan that you feel comfortable with. I'd strongly encourage that it's a written plan, and make sure it takes into account when you're going to start with Social Security, how you're going to choose your pension payout if you have one. Do I have a need for life insurance? And am I truly ready to retire? Or should I work another year or 2 to make sure that my family and I are in the right spot?
Great points across the board. And if you are interested in going down that road of planning for retirement and want to get a written plan in place, one that covers all those unturned stones in throughout the process, that's what David helps people do each and every day in the office as part of the complete planning review process. That's the CPR process that you hear David mention occasionally here on the show. If you'd like to talk to him a little bit more about what it's like to go through that process and how he can help you better prepare for your financial future, here's how to get in touch. You can call 913-317-1414, 913-317-1414. You can go online to coveryourassets.kc.com, or you can even email David, ddickens@kcfa.com. And we'll put all that contact info in the description of today's show so you can find it nice and easy. Well, David, appreciate the help on these irreversible financial decisions. We want to get those things right the first time around, and we know with your assistance we certainly will. And good luck in the golf tournament, and hopefully you're telling us about it next time we join.
I hope so too. Thanks, Walter.
Have a good one and safe travels. And thank you for taking the time to join us on the show today. We'll talk to everybody next time right back here on the Cover Your Assets KC podcast.
Investment advisory services offered through ChangePath LLC, a registered investment advisor. ChangePath LLC and KC Financial Advisors are separate companies.